Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Now, if you've talked to me in the last 2 years, you've probably heard me quote my article titled, Bear Markets, Normal, Not Fun. This is an article where we looked at bear markets, which is, of course, every time the stock market drops by 20% or more. And we looked at it since 1950, and we wanted to see the average time it took to hit the bottom of a bear market. When did it get to the worst of that decline? And just as importantly, how long did it take you to get back to the top, back to where you started from? Well, we learned it took 338 days to get to the bottom on average, and it took 603 days to get back to where you were on average. Well, friends, we can add another top to bottom, back to top to that list. Because as of Friday of this week, which of course is January 19th, the S&P 500 went from a top on January 3rd of 2022 to a bottom in October of that year in 2022, which was nearly 338 days, the average of a decline in a bear market. Not quite a full year, of course. October wasn't quite the full year. And then on Friday, nearly 500 trading days later, it hit back to where it was on that January 3rd of 2022. How about that? In this cycle, it did it with 100 days to spare over the average. Again, normally it takes 603 days to get to the back to where you were. This time it only took 500. We got back to par in 500 days. And that's equivalent to the 1976 through 1978 bear market, where the S&P dropped 19.4, not technically a 20% drop, but close enough. And then it climbed its way back out in 527 days. This week was trending actually negative until Taiwan Semiconductor announced earnings in the week, where we saw a very upbeat report. And all of a sudden, stocks like NVIDIA, AMD, both of which are stocks held in our Whitaker-Myers tactical portfolio, they unleashed a week like you would dream of. NVIDIA jumped 8.7% on the week, and AMD jumped 18.87% on the week. Taiwan Semiconductor, not in our tactical portfolio, but that was up 12.8%. This just continues to show that the excitement around artificial intelligence is not over. And it can continue to drive the stock market up further. It's what drove most of it in 2022. If it continues to develop in a way that improves productivity and profit margins, that's going to continue to help the stocks in the S&P 500 that have momentum on their side. Now, it's time to see what the markets can do post the bear market correction we just completed on Friday. And that's going to be dependent on the economy, which is why this video series is so important. So with that, let's start digging into the economy. First, we always look at the Atlanta Fed's GDP Now model, and right now they're still estimating the growth of the economy in the fourth quarter of 2023. The number will be officially released this coming Thursday, so we're going to know by next week's video what actually happened, and we'll know how close the Atlanta Fed actually is. However, their most recent report, which included updates from the existing home sales we're going to talk about later from the National Association of Realtors, it has GDP coming in at 2.4%, so about 0.2 higher than last week in the fourth quarter of 2023. As I've reminded you many times, at this point in the report, we're nearly 4 business days away from the report being the official report being released. It's extremely accurate, and you can bet that next week the GDP report will be one of our 4 points. Now, next we look at the 15-year and 30-year mortgage each week to see what kind of rate relief we're hopefully getting for homeowners and refinancers as rates continue to drop. As we mentioned, one of our themes for a strong 2024, especially in the second half of 2024, is the fact that mortgage rates are going to continue to drop and rapidly fall, hitting the 5% numbers, in our opinion, on the 30-year rate. And this will stimulate the economy and the housing sector. As you can see on your screen, this theme continued to play out this week as both rates took a step down. Next, and I just can't believe this, these numbers continue to get lower and lower, which almost scares me how low they're getting at this point. Scares me in a good way. The initial claims for unemployment insurance, which of course is a gauge on those going on to unemployment, losing their jobs and going on unemployment for the first time, those dropped to 187,000 this last week, lower than last week's number. And then the continuing claims for unemployment insurance, those that are not able to get off unemployment and so they're continuing to stay on it, they actually fell to 1.8 million. So that number came down. And how about the markets? How did they fare this week? The S&P 500, which is our gauge for growth and growth in income, but only when taken together, that was positive 1.25% for the week. The S&P 500 positive 1.25%, or said another way, your growth in income positive. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was negative 0.58%. And finally, the MSCI EFA, which tracks international stocks in developed countries around the world, excluding the United States, that was negative 1.11% this week. And how about point number 2? What if I told you that last year's home sales, and they were 4.09 million, was lower than the subprime crisis of 2008, 2009, and the lowest full year amount since 1995? That's what the National Association of Realtors told us today, Friday, January 19th, about the year 2023 in regards to home sales. Here's a chart from the National Association of Realtors and the Wall Street Journal showing how bad the year actually was in terms of home sales. When thinking about population adjusted, it makes this number even harder to fathom. It would have been a tough year to be a realtor without an established clientele or a referral source. And of course, as mentioned in point number 1, mortgage rates had a lot to do with why we had such a bad year in home sales. And thus, the supply of homes remains stubbornly low, exacerbating the issue. If rates are now in the 6s and nearly got to the 8s, I'm sitting on my home if I have a 2 to 3% mortgage, and there's little chance that I'm going to sell my property to move unless absolutely necessary, or if I'm buying in cash. But that's even the problem for cash buyers. With such a tight inventory, the average sales price for a single family home in the US last year it peaked at $415,000 and currently sits at $392,000. With millions of millennials looking to hold off on buying their first home, we believe as rates continue to fall, it's going to create an explosion of buyers, making the spring and summer home buying season one of the busiest and best we've seen in a long time, certainly since the pandemic. In terms of supply of existing homes, we currently sit at about 3.2 months of supply of homes on the market, and a normal market should be around 4 to 6 months of supply. So we're below market there. Hopefully, those that have been thinking about selling their house will pull the trigger as rates continue to drop, giving those millennials the opportunity to buy their first house. And point number 3, politics affects the markets, and thus we have to gingerly follow politics in this video series. Most presidential election years tend to be positive for the market, albeit they're positive in the back half of the year. However, the House and the Senate this week made sure, at least till March, politics doesn't play too detrimental of an impact in the first half of the year. The Senate passed the continuing resolution spending bill by a measure of 77 to 18, 77 for, 18 against, and the House passed the measure 314 for, 108 against. So broad support. While this is only another continuing resolution bill, it allows both sides to hammer out the $1.66 trillion budget they agreed to earlier this month for 2024. So there will be no spectacle of a government shutdown this next week, and thank the Lord for that. As you think about government debt, here are some numbers to chew on. As of our last reading, government revenues for this last year are up 17.11%. So they're taking in more dollars, and the U.S. government current tax receipts are around $5.188 trillion annually. Currently, this fiscal year, which started in October of 2023, the U.S. government, as told by the Treasury Department, has collected $1.107 trillion. So let's hope that we can start using some of these dollars to put a dent in that $33 trillion debt number that is hanging out there and continue to go up. Let's see it go down a little bit. Dave Ramsey for president. And point number 4, U.S. retail sales were released this week, and they edged up to 0.6 in December 2023 compared to November, according to the U.S. Census Bureau. This increase, while modest, beat economists' expectations. They only thought we were going to see a 0.4 increase in retail sales and suggested even more resilience in the consumer spending especially during a critical holiday shopping season, which is what this last report covered, of course. The December gain was driven by strong sales in non-store retailers. Think Amazon.com type stuff, which surged 9.7 year over year, reflecting the continuing shift towards online and e-commerce shopping. Food services, which fall into this group, and drinking places, they saw robust growth of 11.1% from December 2022, so a year earlier, as consumers dined out more frequently. However, the numbers also hinted at some potential headwinds for the retail sector, and that headwind, you can probably guess where it's coming from. It's sales at traditional brick and mortar stores. They grew by a more tepid 0.3% compared to November, potentially indicating a slowdown in consumer spending at physical stores. Additionally, rising inflation, which remains near 40-year high, could continue to dampen consumer sentiment and spending in the coming months. So that's why retail sales are such an important number to watch. If you were on our webinar we host each month, you heard from Pat Doherty of Invesco Real Estate, and he explained that while brick and mortar at a large scale is dying and not something you want to be investing in, it's all about the experience and location, meaning some malls are doing better than ever, and it's because the smaller and less desirable malls and retail centers are dying. We see this stat played out in the numbers. Overall, the December retail sales numbers paint a nice picture for the U.S. economy because consumer spending did show some resilience in the holiday season. We did go up. However, a shift towards online shopping could pose challenges for the retail sector and thus the real estate sector that holds those retails in the near future. And that's why investing in real estate, you need a partner that you can ensure when you own retail is owning the right type of retail and owning the things you probably want to hold anyway, like warehousing. And that's where this month's retail sales number shows is the sector you want to be diving into, right? Before it hits your front doorstep, where is it sitting? It's sitting in a warehouse. So if retail sales are growing, but they're growing almost 10% in online shopping, how do you take advantage of that from a real estate perspective? You own the locations that support online retail shopping, not the physical locations, unless you're able to get a physical location like the Mall of America, or Pat Doherty talked about the King of Prussia Mall in the Philadelphia area, a booming mall. But there's many, many malls you don't want to own. All that to say, retail sales, very important. It shows you and I, the consumer, are still spending money, and we are the biggest factor in the U.S. economy, nearly 2/3 of it. So that's a good sign for the future. Hopefully the 4 things we learned in the markets this week were helpful to you. If they were, would you do us a favor? You can always do us a favor by hitting the like and subscribe button. The like button helps push our content out to more people so we can deliver our message out to more folks, as well as the subscribe button helps us push our content out to you as soon as we release it. And this week, not only do you get what we learned in the markets and our question of the week video, but our monthly webinar, which again, as discussed earlier, was all about real estate with Invesco's Pat Doherty, who is a leader in the real estate space, which was a phenomenal conversation he and I had, mainly him giving us an update where I did get to ask a few questions, which was a great time with him. About an hour of your time, which would be well spent. So thanks so much. If you would like to schedule a meeting with any of our financial coaches or planners, our coaches help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt free, build that budget, or our financial planners and advisors who help you in baby steps 4, 5, 6, and 7, build out that retirement plan, pay off the mortgage, and fund kids' college. Those are all things we would love to help you with. Just go to the link in the comments section and you can schedule a meeting with any of them there. Thanks so much. We'll look forward to seeing you next week.